There are 5 reasons to not buy a house. Starting with number 1, mortgage costs. It doesn't matter if you're planning on buying a house in the States, the UK, the EU, or Australia, interest rates globally are at levels not seen for over 10 years. By definition, this makes it the most expensive time to buy a house using debt in over a decade. You see, because of these high rates, it's now more expensive for the banks to source the money that they lend to you for your mortgage. In competitive banking markets, the banks may have to offer higher deposit interest rates to customers to attract and retain new and existing business. For banks that borrow money from other banks and financial institutions, they're now paying a higher rate on their borrowings. This all translates into real costs for the bank. In order to account for these costs, the banks increase the interest rate that they charge on their loans to customers, including mortgages. Having to pay a higher interest rate on your mortgage is a big deal. Even a seemingly small percentage increase can have a huge impact on your repayments to the bank. For example, let's say you borrow €450,000 over 25 years on a 4.5% interest rate. Your monthly repayment will be €2,478.26. By the time your mortgage is paid off, you'd have paid €293,476.23 worth of interest on top of the €450,000 that you borrowed. Now, let's assume the same scenario but with an interest rate of 5%. As you can see, your monthly repayment would increase to €2,601.62 and your total interest paid would be an eye-watering €330,486.55. So a 0.5% increase in your mortgage interest rate resulted in a 12.6% increase in the total cost of your mortgage. In many countries, mortgage interest rates are multiple percentage points higher today than they were just 2 years ago. So if you commit to buying a house now, you're going to be paying tens, if not hundreds of thousands of euros, dollars, or pounds in additional interest as compared to someone who bought their house at any point in time over the last 10 years. Of course, the caveat is that we don't know exactly how long interest rates will stay at these higher levels. That largely depends on how global central banks are feeling about inflation. If rates were to come down in the future, you could always refinance in order to reduce your interest payment, or if you're on a variable or adjustable rate, you may benefit from the lower rates automatically. Nonetheless, there's no denying that by buying a house now, your wallet is going to be taking a big hit from interest payments. And that's in addition to the second reason to not buy a house: upfront and running costs. Mortgage costs are just the tip of the iceberg when it comes to buying a house. There are a multitude of other expenses to consider, not least of which is the initial deposit that's required to secure a mortgage. The size of the minimum deposit that's required will vary depending on where in the world you're looking to buy a house. But it's fair to assume that you'll be required to put down tens of thousands worth of a deposit at a minimum in order to secure a mortgage. This represents a large upfront financial commitment, and the higher the house price, the larger the mortgage, and the more money that you'll be required to put down. House prices across the States, the UK, the EU, Australia, and much of the rest of the world have steadily increased over the past decade. But the increase in house prices was most pronounced post-2020, with house prices today much higher than they were just 3 years ago. As a result, minimum deposits are also much higher. For most people, it can take years to save up the money that's required to purchase a home. All the while, that money could have been used for another purpose, such as investing. So there's a very real opportunity cost associated with buying a house. In addition to your deposit, you then have all of the other costs that come with your purchase: legal fees, surveyor's fees, taxes, among other costs that vary from country to country. These costs can add thousands onto your total cost of purchasing a home. But you're not done yet. When you actually own the home, you then have to account for the annual cost of maintenance and repairs, insurance premiums, property taxes, and utilities. Most people, when comparing the cost of buying to the cost of renting, will simply compare the mortgage payment to the rental payment. But this isn't a fair comparison, because with home ownership comes a multitude of additional expenses that are avoided when you rent versus buy. Here's a pro tip: divide the total cost of home ownership by the total cost of renting. If you get a result of between 1 and 15, then it's likely a good idea financially to buy instead of rent. If you get a result of between 16 and 20, whether you buy or rent will largely depend on other situational factors. If you get a result of over 21, then it's likely actually a good idea financially to rent instead of buy. Reason number 3 to not buy a house is overvaluation and unaffordability. These might sound like the same thing, but they're actually two separate metrics. Whether or not a house is overvalued will depend on the relationship between house prices and rent prices. If you think about a house as being an investment, the income that you would expect to receive from that investment would come in the form of rental income. Therefore, we can take the annual rental income that a property will be expected to generate and we can place it over the purchase price of the property to calculate what's called a rental yield. The lower the rental yield of a given property, the less bang for the buck a property investor will be getting by purchasing it. When deciding between renting versus buying, low rental yields are a sign that it's likely more economical at that current point in time to rent versus buy. In the EU, for example, house prices have grown at a much faster rate than rents over the last 10 years, resulting in a reduction in rental yields. The same is true in the UK, Australia, and the States. When rental yields get too low, there's a real risk that the housing market could face a price correction to bring house prices back in line with their fundamental value, which again is derived from rental income. So because house prices have been increasing at a faster rate than rents, much faster in some cities, they may be overvalued, and now might not be the best time to buy depending on where in the world you are. Unaffordability, on the other hand, will depend on the relationship between house prices and household incomes. The faster house prices grow relative to incomes, the more unaffordable it becomes to purchase a house. According to the Demographia International Housing Affordability Study, where median house prices are over 4.1 times greater than median household incomes in a given market, that market can be described as being seriously unaffordable. Their results show that housing affordability in the States and the UK meet this classification, whereas housing markets in Australia, New Zealand, Canada, and Ireland are classified as severely unaffordable. So not only are property prices themselves overvalued, but the incomes of the individuals who are looking to buy those houses simply aren't high enough to make the properties affordable. The fourth reason to not buy a house is negative equity and the risk of using debt when purchasing a home. If housing markets globally are considered to be overvalued, and if there is indeed a downward correction on the horizon for certain housing markets, then it's really important to understand what happens when you purchase a home using borrowed money and house prices subsequently start to fall. Say you purchase a home for €400,000. You put down a €40,000 deposit and fund the remaining balance with a €360,000 mortgage. What happens if the value of the property falls by 10%? It was worth €400,000, it's now worth €360,000. Pretty straightforward. However, the reality is so much worse. If you sold the property there and then and collected €360,000 from the sale, what would happen to the money? All of it would go straight to the bank to repay the mortgage. What about the €40,000 of your own money that you initially invested? It's gone. So a 10% fall in the price of the property resulted in a 100% wipeout of what's called your equity or ownership value in the home. The reason why that happened is because you used borrowed money to make the purchase. That's what's called leverage risk, and it refers to the risk of using debt to make asset purchases. No matter what happens to the price of the property, you will always owe the bank what you originally borrowed. If the value of your property is worth less than the loan outstanding, you're said to be in negative equity. So even if you sold the home and gave the bank all of the cash that you received from the sale, you'd still owe them money. Society has normalized the use of debt to purchase a house. And while the outcome isn't catastrophic most of the time, that's not to say that there's no risk. There is. And that's especially true when the property that you're purchasing is overvalued to begin with. The fifth and final reason to not buy a house is inflexibility. Buying a property is a very significant life commitment that can't be underestimated. When you purchase a house, you're more or less committing to live in one specific area for a decent amount of time. Your ability to explore and move around becomes limited. Sure, it's possible to sell your home and move elsewhere, but it can't be described as an easy process. From a financial perspective, you'll have less capacity to explore new things and take risks with a mortgage looming over you. After all, a mortgage will likely represent the single largest liability that you'll ever take on in your lifetime. It becomes harder to invest your money, pursue entrepreneurial endeavors, travel, and fund further education when you have to shoulder the cost of a mortgage. In short, the commitment of buying a home comes with with unwritten lifestyle expectations that are oftentimes quite restrictive. If you value your freedom, you might think twice about buying. That's 5 reasons to not buy a house.